The United States is entering a new era with the election of Donald Trump for his second term. So far, the stock market has been happy, and it's going to be interesting to see what happens to the economy over the next few years. But our number one economic adversary in the world, China, is also entering a new era. Not a new leadership era, but a new economic era. We need to talk about it so everyone out there is informed of what's happening, because it's getting crazy. This is your week in money. The simple thing is, China's economy is struggling, finally, after decades and decades of endless growth. So let's hit some of the major reasons why, then we'll go into what they're doing to try to fix it, and then many economists' outlook of where China will go by 2100. One of the main key reasons why China is struggling right now is their overdependence on the real estate sector, and that sector is declining massively. The property market there is experiencing a huge downturn. The collapse of major developers like Evergrande has led to halted projects and declining property values, eroding consumer confidence and reducing household wealth across the country. The thing is, many people in China put their retirement into households instead of any kind of stock market. So what's happening? One of the leading causes of this is that developers accumulated substantial debt through aggressive borrowing to finance rapid expansion. The introduction of the 3 red lines policy in 2020 imposed strict debt limits, leading to liquidity crises for major firms like Evergrande. And then years of extensive construction have resulted in a surplus of housing units, including numerous so-called ghost cities with unoccupied properties. This oversupply has driven down property values and reduced demand. And then these local governments, which are heavily reliant on land sales for revenue, face financial strain as demand for land decreases. This decline limits their ability to invest in infrastructure and public services, further dampening economic growth. And then there's policies aimed at curbing speculation, such as increased down payment requirements and restrictions on multiple property purchases, and this has cooled the market by reducing speculative investments. And economic uncertainties and high-profile developer defaults have eroded public trust in the real estate sector, which is leading even more to decreased property purchases and investment. Now, across China, we're seeing their aging demographic and a deceleration in urban migration, and this has reduced the demand for new housing, contributing to the overall market's decline. And then there's the simple fact that across China, rising household debt levels have constrained consumers' ability to purchase homes, leading to an even further slowdown. This is just endlessly compounding at this point. But we can compound even further because trade tensions and global economic slowdowns have impacted China's economy, reducing foreign investment and affecting sectors linked to, guess what? Real estate. Then the government came in and said, hey, you guys aren't struggling enough, and put even stricter environmental regulations and land use policies that have limited available land for development, affecting the supply side of the market. The real estate sector's downturn has led to increased non-performing loans in banks, creating financial instability and reducing the availability of credit for new developments as well. Simply, the real estate sector has been a significant contributor to China's GDP, accounting for up to 29% of economic activity, and its decline directly impacts overall economic growth. Real estate development and related industries provide substantial employment across the country, and a downturn leads to job losses affecting income levels and consumer spending. And then tie that into local governments, and land sales have been a primary revenue source for them. A decline in the property market reduces this income, limiting public spending and investment. The sector's struggles increase the risk of default on non-performing loans, posing threats to the overall banking system and the overall financial stability of the country. As I said, property is a major asset for Chinese households. Falling property values reduce household wealth, and China already has a major consumer spending issue. Addressing these challenges is critical for China's economic stability and growth. Now, some other major reasons why China is economically struggling involve high local government debt. See, local governments have accumulated substantial debt across the country, estimated at $12.6 trillion, or 76% of GDP in 2022. And those are local governments alone. This debt burden limits their ability to invest in infrastructure and public services, constraining economic growth across the country. Then, as previously mentioned, there's weak domestic consumption. And this is despite China's policy efforts. Domestic consumption remains sluggish across the country. Factors such as high household debt, a lack of social safety nets, and economic uncertainty have led consumers to save rather than spend, hindering economic momentum. You'll know here in the USA, we love to swipe, and throw that money out, and consumer spending in the United States was one of the reasons we saw GDP growth of this last quarter year over year. Now, many countries are dealing with this, but China more than ever. Their population is rapidly aging and shrinking the labor force and increasing the dependency ratio. This demographic shift strains public resources and reduces economic productivity, posing long-term challenges. And then and what we're probably about to see even more right now, there's ongoing trade disputes, particularly with the red, white, and blue United States, baby. And this has led to tariffs and export restrictions. These tensions disrupt supply chains and reduce demand for Chinese goods, impacting the manufacturing sector. And then we can look back a couple years and see that the global supply chain had major issues affecting China. This was exacerbated by the COVID-19 pandemic, where China locked down heavily.
3 weeks into lockdown, some here in Shanghai are angry.
This affected China's manufacturing and export sectors. Lockdowns and logistical challenges have led to production delays and increased costs. And once again, China was like, you know what? Let's get the government involved and make it even harder for the economy to grow. The government's stringent regulations on sectors like technology, education, and real estate have created economic uncertainty. These crackdowns have led to reduced investments and layoffs, affecting economic stability. And even with different regulations in their environment, China faces significant environmental issues, including pollution and resource depletion. Efforts to transition to a greener economy require substantial investment and structural changes, which can temporarily hinder growth. And we already know that local governments are borrowing up to their eyeballs, and it's even harder to invest in new technology and more expensive technology now. And then mixing it all together back to the real estate, the banking sector is grappling with non-performing loans and shadow banking activities. Financial instability poses risks to the broader economy, necessitating cautious monetary policies. And for what it's worth, we have seen a deceleration in global economic growth, and this affects demand for Chinese exports. Additionally, geopolitical tensions and protectionist policies across the world create an uncertain international trade environment. So you might be asking yourself, what is China going to do? What are they going to do to turn this around? Are they going to be able to? Right now, investors are anticipating a massive fiscal stimulus from China, with estimated plans around 10 trillion yuan, or $1.4 trillion, in freedom coins. The Standing Committee of China's legislature began a session on Monday where investors hope for clearer details on the scale and structure of any upcoming fiscal measures. And while the stimulus headline amount is significant, investors are advised to scrutinize how the funds will be allocated, as much of it may not directly stimulate economic growth. So I know a lot of you have been sharing how bad credit is holding you back from reaching your financial goals. I'm talking about struggling to get a good loan for a house or car, not qualifying for the best credit cards, or even having trouble renting. But I recently found something that can help you build credit without piling up more debt. Let me introduce you to the sponsor of today's video, my friends over at Kickoff. Kickoff is the #1 credit building app on the App Store and helps you grow your credit fast without the temptation of overspending. Starting at just $5 a month, Kickoff reports your on-time payments to all 3 credit bureaus. With AutoPay, you can build credit on autopilot. I'm talking especially to those with credit under 600, because the average Kickoff user jumps 28 points in their first month. You make on-time payments, credit bureaus see good behavior, and your credit grows. Got rent you already pay monthly anyways? You can even report that to build credit with a premium plan. Plus, you'll get free credit monitoring fast, easy disputes right from the app to stay on top of everything. The Kickoff app is super easy to use. Check out the over 100,000 positive reviews on the App Store. 98% of them are 5 stars, so trust me, you're in good hands. And it doesn't end there. Kickoff requires no credit check, has no hidden fees, and no interest. And don't worry about the endless customer service calls. They let you cancel any time. And the best part, if you're listening to this show right now, you can try your first month of Kickoff Basic for free. Head to getkickoff.com/YWIM to claim your free month and start building credit today. Your future self deserves that decision, and it's literally never been easier. Thanks to Kickoff for sponsoring today's video. Now let's jump back into the episode. But here are the key components of the expected stimulus package. Debt burden. Local governments in China carry extensive debt, as we already talked about, from public spending on infrastructure and education, but lack consistent revenue sources. So there's going to be some restructuring of these local governments and their debt, potentially. And then local governments circumvented borrowing limits using local government financing vehicles, which are state-owned entities, to avoid Beijing's restrictions. Goldman Sachs estimates that LGFV debt was approximately 60 trillion yuan by the end of 2022. And as we already talked about, China's struggling housing market has slashed proceeds from land sales, and this is a key source of income for them to pay off these debts on a local government basis. And because of this, Goldman Sachs estimates a 2.3 trillion yuan revenue shortfall from local governments this year alone. So here we might see Beijing absorbing some local government debt, which would reduce their interest obligations, potentially freeing up capital for public spending. And the housing market downturn is a central issue affecting the broader economy. So the central government may issue bonds to buy a portion of the millions of unsold homes, helping stabilize prices. JP Morgan estimates that 4 trillion to 5 trillion won would be necessary to reduce housing inventory to a level where prices might stabilize. Earlier this year, local governments were directed to reduce excess housing inventory, but they lacked the fiscal capacity to do so effectively. Direct funding from the central government could provide more substantial impact. The stimulus package may also include measures to support consumption, such as enhanced welfare payments and trade-in subsidies for consumer goods. But many economists say that investors should temper expectations, as Beijing has been reluctant to issue direct cash handouts. Strict austerity measures on property developers and local governments have already contributed to a deflationary economic environment. So are you really expecting the Chinese government to be smart here? So far they haven't been. Now, while restructuring local government debt and reducing housing inventory may prevent a more severe economic downturn, they may not be enough to boost substantial growth. Official Chinese government national debt is reported at just over 50% of GDP. When including LGFVs, however, China's public debt to GDP ratio has increased significantly. In 2019, it was 73%. By the second quarter of 2023, according to Morgan Stanley, it was 102%. So rising national debt levels coupled with declining tax revenues may discourage Beijing from implementing a large-scale consumption stimulus. The expected stimulus package will likely provide a more stable foundation for China's economy, though, particularly by addressing debt and housing issues, the major things we've covered so far. And economists suggest the measures may prevent further decline, but they are unlikely to drive significant economic growth. But there may have been some good news that just came out this week after the United States election for China. Chinese exports rose 12.7% in October from a year earlier, showing a significant jump from September's 2.4% increase. And this export growth was notably above the 4.9% growth expected by economists in a Wall Street Journal survey. And the accelerated export growth comes as the Chinese economy seeks to regain momentum, with exports providing essential support. Economists suggest that exports may have front-loaded shipments to mitigate possible impacts of a trade war next year, particularly with potential tariffs from the United States. So this may have been preventative action and boosted these numbers and made China look a little better right now. Exports to ASEAN, China's largest trading partner, rose by 15.8% in October, a substantial increase from the 5.5% rise seen in September. And then when it comes to the European Union, China's second largest trading partner, this climbed to 12.7% in October, which was much higher than the 1.3% recorded in September. For the United States, it rose to 8.1%, improving from the 2.2% increase in September. Some economists expect Chinese shipments to remain strong in the coming months, but they note that any negative impact from potential tariffs imposed by the United States might not affect exports until the second half of next year. Donald Trump's return to the White House is anticipated to temporarily boost Chinese exports as United States importers may increase purchases ahead of possible tariffs. But on the other side, inbound shipments to China fell by 2.3% in October compared to a year earlier, which was a sharper decline than expected, in contrasting with a 0.3% increase in September. Economists had anticipated a smaller decline in the imports of 1%. Due to the strong exports and weak imports, China's trade surplus widened significantly. The surplus increased to $95.72 billion in October, up from $81.7 billion in September. This figure was also above the $74.4 billion trade surplus economists had predicted. And with the potential stimulus, some economists suggest that the stimulus package could bolster demand for imports, particularly for industrial commodities, over the next few quarters. But what's next for China? Where are we looking by 2100 for our largest economic adversary in the world? The thing is, economists' projections for China's economic trajectory through 2100 vary, reflecting a range of potential outcomes influenced by demographic trends, policy decisions, and global economic shifts. But for a short to mid-term outlook, analysts anticipate a slowdown in China's economic growth compared to previous decades. Factors such as the aging population, diminishing returns on capital investment, and structural challenges contribute to this deceleration. Projections suggest an average annual growth rate may decline to around 2 to 3% through 2050. And China's past population policies have led to a demographic decline that we already talked about and essentially locked them in for the coming decades, with limited ability for policy to materially alter the outlook. This demographic shift is expected to impact the labor supply supply and economic productivity. Now, when it comes long-term for China, some analysts suggest that China's economic zenith may be reached slightly before mid-century, after which its relative economic scale could decline. And this projection considers factors such as demographic trends and potential shifts in global economic dynamics. By 2100, projections indicate that other nations such as India may surpass China in terms of GDP. For instance, estimates suggest that India's GDP could be 36% larger than China's by the end of the century, with Nigeria also emerging as a significant economic power. China's ability to continue fostering innovation and integrating advanced technologies will be crucial in sustaining economic growth. Investments in sectors like artificial intelligence, digital financial services, and green technologies are expected to play a significant role. Implementing structural reforms to address issues such as high debt levels, population aging, and slower productivity growth is essential. Policies aimed at boosting consumption, improving the business environment, and enhancing social safety nets could support more sustainable growth. China's future economic trajectory will also depend on its integration into the global economy, trade relationships, and responses to geopolitical developments. Maintaining efficient supply chains and access to global markets is vital for their continued growth. So in the end, while China's economy is expected to continue growing, the pace is likely to slow, with potential shifts in its global economic standing by the end of the century. Addressing structural challenges and fostering innovation will be key determinants of its long-term economic health. I'll see you guys next episode. This is huge for financial audit. For a year now, my team and I have worked with experts to create what I truly believe are the 3 best educational programs in the financial space online. We have our budgeting program where I teach you how to create, manage, and revolutionize your budget and control your money. And then there's the investing program where I teach you to define what investing profile applies to you and your life, and then teach what specific investing strategies applies to you in that situation. And now finally, we have our debt program where I teach you the best ways to pay off debt, manage debt, and even take advantage of good debt. This has been a revolutionary project that we've been working on for over a year now. And just like over 10,000 people who've already taken our educational programs, you can now take advantage of all 3 of them bundled together at a 25% discount. I've heard from thousands of people now who've taken these classes and they've literally changed their lives for the better. And finally, you can too at a more affordable price. Head to calebhammer.com or click the link in the description below. You will not regret this.